Welcome back to your Mortgage Insider Update for this week. August is kicking off with a bang, not in a good way. Overall interest rates had a rocky week this last week. We are anticipating the CPI report coming out this Friday. So new news on consumer price index. We'll also, following that, get producer price index. But we don't have a lot going on with the Fed for a number of weeks, about 6 weeks until the latter part of September. They're ending their next policy meeting on September the 20th. But between now and then, they have a symposium. And this is the reason for the delay in the next Fed meeting, will be in Jackson Hole, Wyoming. And just a year ago, the Fed chairman had a very short, very direct speech for the economy and at that Worldwide Economic Symposium, where he said that it was going to be painful. They were going to inject pain into the economy, and they followed through on that. We've seen it be very painful. Interest rates have gone to a 23-year high as of this last rate hike. Let's check out and see where the markets land today. So this week we're going to start off with the 10-year Treasury. It is well over 4%, 4.08%, up 4 basis points today. I have this chart spread out for a whole year, and we can see interest rates have peaked beyond their high point for 2023 back at the very first week in March, right before the Silicon Valley Bank went under. So we had a huge pullback, just very trying time in the banking industry, which still has a lot of headaches and a lot of pressure from higher interest rates. But we can see that the next level of worry in the economy is, since last November, we peaked in October. This is 1 year ago. We had the climb from August of last year, interest rates where the Fed made it really clear it was going to be painful. They're going to raise rates, and we saw them skyrocket, hit the high point back in late October, peaked there at the beginning part of November, and we've been in better interest rate territory, amazingly, since then. Now, if we just look at the most recent history, we did see the high point just this last week on August 3rd. We actually pulled back on Friday, a little bit of better news in the jobs economy. Jobs were strong, but not as strong as predicted. Less than 200,000 jobs created in the economy. The unemployment rate remains stubbornly low. So we did see a little pullback, and as we start this week off, we are settled in on the 10-year Treasury right around the same level as we peaked on July 7th. That means that for the month of August, rates are already higher than they were in July. So we'll bring you the CPI numbers at beginning of next week, and also producer price index. We'll hope for a little bit better number, but we are likely going to see not a 2 handle on CPI. We did come in at 3.0% this last cycle for June. So we are expecting July's number to tick up slightly. We could see producer price index around 3.2 to 3.1%, slightly higher year over year compared to last year. Now remember, June of 2022 was the peak in rates, or peak in inflation, I should say. So June of this year, we saw a significant fall in the year-over-year inflation. So we're settling in right around that 3% range. That's not 2% like the Federal Reserve would like, but it is far lower than the federal funds rate. So we're hoping that the Fed and all the governors can come together in September and just hold off a little longer and let the inflation subside. It does appear to be subsiding, but not as quickly as we'd like. Have a great week.